When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio. This is John Galt speaking, and what a day, what a day, what a week. Today's special guest, Vinh Vuong and Willie Costa, will be joining us in just one moment. I'm just going to hit a quick market review because in the time that I wrote down the numbers 10 minutes ago until the time this show began, there was a full bull move effort to try and salvage the month. So I'm just going to skip the month-end data and just give you a quick summary heading into the close. Dow up 600, NASDAQ up 302, S&P up 92, Russell 2000 up 10, showing the true weakness in the market. They managed to sit there and crush the volatility bulls with a unbelievable decline back down below 21, where it's been hanging all day. Gold down $37 to $28.64, still up 4% for the month. Silver down 37 cents to $31.42, also still up over 4% for the month. Oil flattish, finishing the month at $70.08 for WTI, down 46 cents to 73.11 for Brent. The big news was in Bitcoin, which is absolutely devastated in the last week. Finishing pretty much flat today at 84,340 after an adventure all the way down to 79,000. And a really wild ride for the month. The 2-year at 3.99%, 10-year 4.21%. Absolutely huge moves in credit, and there is a reason for that. We'll talk about that with our guests in just a minute. The 2s, 10s are at 0.23 23 basis points. The 3-month 10-year reinverted and is at a negative 9 basis points. Without further ado, welcome aboard, Vinh and Willie. What a month. Either one of you want to take a stab on what to make what we've witnessed the last 28 plus days?
Thank you for having us. Really appreciate it. And thank you, Willie, for joining me. As everyone knows, Willie and I are both business partners, co-founders of Garrison Fathom. We're an asset management firm. We have hedge funds and private equity funds that we run and manage, but we manage it responsibly. We invest in quality companies with long-term vision, and we don't contribute to what the rest of Wall Street does, which is try to inflate numbers and inflate reality, and then screw shareholders over, which the company gets screwed over as well. So just for background there. So for the past 28 days, where did we begin? Willie and I have been very vocal about where the economy has been for the past 18 months, right, Willie? We've been very, very vocal.
Yeah, just about that.
About the true state of the economy. And I think reality might be starting to set in. And I think, ironically, the Trump administration and its policies are really starting to unravel it all. So leading to February, what we saw has been, in short, the government spending more than the private sector to compensate for what we saw a private sector recession. They were outpacing the private sector to be able to prevent a overall recession. And then now with the Trump administration coming in and they're cutting spending, they're laying off government jobs, in which, by the way, government was out hiring the private sector for quite a while. So now that reality comes in. And I think that exposes the true state of where the economy is. The consumer confidence has always been bullshit. It's been made up. People have been buying everything with debt, and consumer debt's all-time highs, and people are now starting to be delinquent and all that. So there's just a lot to unravel. Willie, I'm sure you have plenty to say here.
I believe I do. And I think you hit the high points here. My big problem with much of what we've experienced the past couple of years You brought up, Vin, the issue of government hiring outpacing the private sector. That should concern everybody. In a rational economy, the government is what's called the lender of last resort, right? When everything's about to go to hell, Uncle Sam will step in and make investments and kind of spur economic growth. But the flip side of that is the government should also be the hirer of last resort. And the fact that so many of the jobs that have been created over the past 18 months or so, as Vin said, you get these jobs prints and everyone's happy, and then you dig deeper, like, oh, but most of that, a lot of that has been in the government sector. Yeah, that should concern people, because we get to the point where, the government is not supposed to prop up the labor market. Private industry is supposed to prop up the job market. The government is there as a backstop. So I think it begs the question, if government hiring has been that aggressive, what the hell is the meaning behind it? Is the economy as resilient as many people claim it is? And we obviously don't think so. We've been very public about that multiple times.
Right, and that's just it, right? I mean, I said it already. Reality is settling in. Wall Street and DC Wall Street has traded off of the delusions of the government, right, Willie? I mean, we've said it before.
Yes.
The government puffing up the spending and to try to make up for the lagging economy has given Wall Street the ability to trade at multiple levels, right? Like 50 to 100x sometimes of what true value of a lot of these companies are. So you just see people just being really irresponsible in general, and not sticking to their principles of what investing really is, and what we fear is a pretty much, I'm not saying a full collapse, but a pretty bad recession that's going to happen. And I think investors are starting to wake up to it. And the big reasons because of the inflation data, the job numbers, that's playing a role, and then the instability of what Trump administration is going to do. I get what Trump's trying to do with the tariffs is a negotiation tactic, and all this, but end of the day, that's inflationary. That's what people have to realize. And I think the timing of what he's trying to do is really not the right timing. The economy is sensitive, and this is just not the way to approach it now. And then the GOP bill that passed a bill on the floor, and where it's going to cut taxes by $4.5 trillion. It's going to cut spending by $2 trillion, and then it's going to raise the debt ceiling by $4 trillion. So none of that is addressing the core issue here of what's going on in the economy. It's just no one is willing to step up and actually do what is necessary, and which is unpopular, to correct the economy. That's just the bottom line. It's Econ 101, right? We talked about this in our podcast before. What has happened to date is this. You have the Fed sitting around and waiting and seeing. So during COVID, right, when COVID hit and the shutdown happened, what happened is you have a demand shock, right? Inflation's all about supply and demand. So you had a supply shock. So everything deflated. There was a lot more supply than what the demand was. As soon as the world came back, right, when COVID, when all the lockdowns started to lift, supply has already gone down, right? And then now there's a surge in demand. That's where inflation really started to happen. And what we call that we call it a COVID inflation tax that we're still paying for today. So it surged, Willie, about like 20%, right? So really the cost is about 20%, I would say, the inflation, true inflation number there.
Depending on which one you're looking at, yeah. All the metrics,
Yeah.
the big four are up
So
at least twice as much as they would be had
right,
Hal done what Vin is suggesting and done his damn job.
right. So it's about
inflation.
20%, right? So it says 20% there. But then ever since then, inflation continued to go up. At one point, it was 6 or 7%, right? And inflation has continued to go up. And that's what people have to remember. A lot of data can be misconstrued and narratives can be misconstrued. That's one of the biggest damn problems with financial media. So
don't get me started on financial media, Vin, because
exactly,
one of the
John.
things that really aggravates the hell out of me is the lack of honesty and data reporting. How many, and you two can answer the question, and this is rhetorical for the listeners. If you pay attention to financial media, you didn't hear one word about PCE being revised up in the GDP data this morning, and it was revised up to 2.9%, considerably above target. That is a red flag. And I'm going to go throw this question out into the mix because you two have brought this discussion up right up to the front. We've been talking for months on MacroEdge about a stagflationary outcome. This is looking more and more likely as we're moving forward with cycles of 0 to very limited growth and spikes in inflation. Is that not the only solution the Fed has? Because if they don't allow a stagflationary cycle to happen, there's no way in the world we'll be able to service this debt.
Right. Last year at the end of our 2024, we had a forecast. Our forecast was a market correction of 15 to 20% overall. We call for stagflation. And the big reason why is, we see that that the government is doing nothing to really address the core issue of what is causing inflation. So demand is being inflated by debt and spending, and no one really addressing the spending by both government and consumers, right? Consumers are still spending like crazy. But Willie, you want to address that?
I think you hit it right on the head. The revision upward is serious. That should absolutely get more attention. We certainly love to pillory the Fed over a good revision like anyone else. But the stagflationary issue is absolutely a threat. And I don't know if you guys saw this just today at 11:30 this morning, the Atlanta Fed GDP tracker released their estimate for Q1 25, and it's a negative 1.5% growth expected for GDP. So we're already seeing the inflation we've seen for the past 4 years. Everyone, every time you go and pay $20 for a dozen eggs, you get to feel that, even if you don't necessarily understand what Powell's saying on the press conferences, you feel it intuitively. But now even the Fed itself is saying, hey, something is wrong here. Everything short of coming out and admitting that, yeah, we screwed up. Now I think we're starting to get a very dangerous confluence of high inflation and GDP contraction, a recessionary cycle coupled with high inflation, the stagflation that you mentioned. The problem is, for those who were fortunate enough to not have lived through this in the 70s and who haven't bothered reading history, when you get into a stagflationary issue, there's no policy solution that the Fed can undertake that is going to save the economy from it. Because whatever the Fed can do with interest rates, with reserve rates, with M2 in the economy, whatever knob they twist, addressing one makes the other one worse. So we've said multiple times the correct time to address this was in 2021. And the problem is that if we do get into a stagflationary period, which we are not the only ones who have said this, even Jamie Dimon, in his own reserved way, a few months ago said, hey, by the way, writing's on the wall, so pay attention. Even if we do get into that, there's no way out without a massive supply shock, which is something by definition that the Fed cannot control. So this is very dangerous territory. And if you're not pissed off at Powell for what he's done over the past several years, you're probably just not paying attention.
Right. And the policies in DC are not helping at all. I get Scott Bessent's strategy of 3-3-3, right, which is 3% GDP growth, 3% government spending cuts, and then 3% energy output. The numbers still don't add up. And when you have a administration that is trying to cut government spending, which I think is necessary, And then while trying to drive economic growth through tax cuts and through deregulation and all that, which we agree parts of that and everything, it's not addressing the issue of actually managing inflation. If anything, the $4.5 trillion tax cuts is going to spur more the demand side and not curving the the supply versus demand. So that's a big problem that we see with it. So it's put this way, a hot mess for the economy, to say the least. And it's confusing because we're in a time in where everything is just contradictory, right? It's just, it's just a time of chaos, and I think this is why traders or investors or whatnot are just kind of in limbo. And that's where this is going to be one of the most volatile years I think you'll see in a long time, because nobody understands where we're at. Is the GOP going to pass this bill? Is tariffs going to be greater or lower? And is the consumer where is the consumer truly? We think the consumers are really hurting, and it's going to get worse. But we're playing a cat and mouse game. But what does that mean? That means stagflation. Stagflation means it's just stagnating, right? And I think we're about to hit that in the next couple of months.
Well, to be honest, I think that our wonderful Fed chairman, Jay Powell, who lit this fuse, is not going to seek another term, obviously. If anyone's reading the tea leaves, it's obvious. He is going to try and get out, unlike Paul Volcker, more like William Martin, who saw the coming inflation that was created under Nixon and the decoupling from gold, et cetera, and all the policies that Volcker encouraged during the 70s. I have a feeling that Trump is going to pick a sycophant who will engage and allow this inflation to continue, thus the stagflationary outcome with cyclical outbursts of growth and higher inflation. With that in mind, what do you think is pressing bond prices down? Because both of us, you guys looked at it, analyzed it, thought that bond prices would continue, the yields would continue to rise. Instead, we've had a rather strong rally, which I feel and many others have commented in FinTwit and the financial media that this is a flight to safety move more so than a belief in economic strength or recession forthcoming.
Mm-hmm.
What do you think? Yeah, Willie, I'll let you lead with that. I know you have a very strong opinion on that.
So you're absolutely right. We did predict bond prices would increase. Well, certainly we predicted the yields would increase after the Fed's tripartite stupidity late last year with rate cuts. Why are bond prices falling? I don't believe that there's any one issue that we can point a finger at. Certainly, uncertainty in the market is probably one of them. But my question is, how much is the flight to safety and the hoarding of cash going to influence things? And we've seen, I think we posted, Buffett is sitting on what, 320 billion or something like that, and
335
35. Jesus. And we've seen more and more liquidity leaving the market. I think the flight to safety argument is probably correct. Why haven't bond prices spiked? Well, maybe nobody wants to buy them. Is there any safety left in the market given the current situation? I think is a much more painful question that we should discuss.
Yeah,
I agree. Vin, go ahead. Please go ahead, Vin, because the other flight to safety we saw was a 4% despite the recent declines in gold. But gold and silver were up over 4% for the month. Mm-hmm. Now, that archaic relic of a metal is sitting here looking pretty damn good when central banks are still buying on every price decline. And they're buying treasuries. They usually don't go hand in hand like that. So I think your comment, Willie, about a flight to safety is absolutely dead nuts on.
I wish it
we
worked.
Should start to get concerned about next. Oh, me too, because it means very bad things are about to happen. That usually is a precursor to some rather outsized market declines. Vin, take it away.
Yeah, I totally agree. I think we're on the cusp of a major shift in the market and where people are going to leave for safety. I mean, I know us as a fund, we're looking at it. There is, if you look at stocks in general public market, right? you can't tell me many stocks that are a good buy right now. There's not many. Absolutely everything is inflated. And a big part of that too is, correct me if I'm wrong, Willie, is retail investors too, right? I mean, retail investors have played a big role in also inflating the markets.
Yeah, that's absolutely true. And granted, Reddit is probably not a really good investing research tool, but if you do scan some of the more wild subreddits, yeah, there are a lot of people getting cratered. I think we're reaching the point of desperation when it comes to a lot of so-called investors. I know we don't invest entirely on behavioral economics, but let's be honest, people just don't make sense sometimes, even when they ought to act a little more rationally. The fact that we're getting this much volatility, I wouldn't be surprised if the retail traders, not investors, big difference. I wouldn't be surprised if the retail traders just start swinging this market wildly from one end to the other, just because people, I think, are getting to the point of desperation for a variety of reasons, and that's obviously extremely dangerous when you're driving, the world's most powerful economy.
Yeah, so that's what we're seeing right now, and the uncertainty. It's two factors, right? Institutional investors right now are seeing several things we're seeing, right? Okay, you see that the numbers with PC inflation, you're seeing start spending is getting weaker. You see GDP numbers being revised. So I think a lot of people kind of knew that something was coming. It's just when, and I think they're now starting to see it peak or starting to appear now, and that's what Willie said. The flight to safety, I think, is occurring. But one of the things we also noticed too is AAA rated commercial real estate bonds and debts, and then AAA what you call it corporate bonds too, Willie, are starting to see signs of weakness, put it that way. And that is not looking good. So when you start seeing those AAA rated, the domino effect can get pretty ugly. You want to elaborate on that, Willie, at all, or
No,
that's something
absolutely.
we talked about? Yeah,
absolutely. Now, just for the record, neither one of us is cosplaying Christian Bale and trying to decipher
yeah,
whether these are true pure play AAAs or they're AAA because they've been diversified with various shovelfuls of shit. But the fact, what Vin brought up about the commercial real estate market should be concerning a lot of people. And I'm not qualified to speak as a civil person on return to office because I'll go ham. But the simple fact is that in 2025, you're going to see a lot of the loans, the CRE loans that were packaged and bundled and sold off in the heyday of the 2020 near zero interest rate environment start to either balloon or need to be refinanced. Well, interest rates are a little bit higher now than they were in 2020, and what you're seeing, a lot of this is unraveling in the commercial real estate space. You're seeing office buildings empty, being sold for pennies. You're seeing the buildings almost being worthless relative to the land. Yeah, even in places like Manhattan, Chicago. I know Bloomberg, maybe a month and a half ago or so, did a really fantastic dive on how many of these once popular buildings in once high demand areas are just skeletons. My question is, well, not a question. My fear is that we might see several issues coming to head at the same time, a cascading fault, kind of like what we had in 2008. Vin mentioned a credit crunch among consumers. I think he's absolutely right. Consumer debt is at record levels. People are living more and more on credit cards. Default rates are going up for credit cards, for auto loans, for mortgages. We have the BNPL that I will let Vin rail on because I know he loves it. And now we have several massive, and we're talking well into the billions of CRE loans that are either going to balloon or need to be re-rated, refinanced at a much higher rate this year. So what's going to break first is my question. I don't know, but for my part, I certainly see all three of those legs of the stool getting kicked out from under us, probably starting in Q2, maybe Q3.
Vin, Willie, I'm gonna go Vin real quick. I'm gonna jump in on that theme real quick. We've seen a pause in the threat to the regional and community banks only because the Trump regulatory team is not totally cemented into position. In about 60 days, that team will be in place, and they're going to open the books up and go, good Jesus, Lord Jesus, they kept this alive for the election. Do you think that we're going to see the kind of disasters that we saw with 3, 4, 5, 6 failures a month, primarily in the regional and community banking space? And our society is not ready to go through that again because we've had an entire generation of quote unquote young investors say, well, that's not possible. The government always bails us out. Is that a big risk that people are paying attention to?
Absolutely. I mean, put it this way. We're having a conversation with one of the top crisis bankers. He's one of the folks, one of like the handful of people that governments and treasuries and top banks call during a crisis moment. And they did an analysis, and right now there's about 250 to about 300 banks that are really in trouble, put it that way. And they're on the brink as it is. And Willie, I'm sure you can elaborate.
You want some numbers, Vin, that'll terrify you? I have numbers that terrify you.
Yeah, so before you elaborate on that, before you elaborate on those banks, right, which are on the cusp. So yes, we do see a major banking issue. One of the biggest things too is what everyone sees right now is the public stock market. Right, Willie, you have talked about this. You see the public markets. People forget about the private market, right? The private market is massive. Okay, we're talking about private credit. We're talking about shadow banking. I mean, it is absolutely a big behemoth that I don't think people are ready for, because if you look at these private ones and how they do things, right? I mean, the banks, you have another thing going, right? The banks, they actually have more checks and balances now, and they have different types of stress tests. But the private shadow banking market, their stress tests are a little bit different. They're not ready for binary issues, right? And they admit it. I mean, when they run these stress tests, they do a lot, but they don't calculate these major binary issues. But Willie, you want to elaborate more on the shadow banks and the as well as the 250 to 300 banks that we identified? And to our listeners, I apologize. I'm as energetic as normal. I took a red eye, so that's why we have Willie as well.
Sure. So, and I want to be absolutely clear. What I'm about to say is not data that we made up or that has been given to us by a Ouija board. This has been published by FAU among other entities. This is all verifiable. And one of the things that Vin's talking about, for those who are not familiar with the intricacies of banking, banks have something called CET1, Core Equity Tier 1, which is equity capital and retained earnings. This is supposed to be like the most rock-solid, stable type of equity that you could have on your balance sheet. And if you look at the distribution of banks' exposure to commercial real estate, the national median is about 276% of Tier 1 equity. So that means the banks are carrying 270 their CET1 equity. 276% of that is now exposure to CRE loans. Now, when you get above 300% of CET1 exposure, that's what's actually considered excessive. And there's almost 100 banks nationwide that have that level of exposure. So I know we're going to get to the public markets here in a moment. What happens when the first domino falls? Yeah, and if you look at the data, which again are public, some banks are 600% exposed to commercial real estate. So you asked, could we see another set of bank failures? Yeah, I think it's not only possible. I would be surprised if it didn't happen. The real question to ask is, as we saw with Silicon Valley Bank, is it going to be contained? Or is this actually a contagion? Can you get a cascading set of failures? We can't just throw up our hands and pray for Chase to save us all. So yes, I absolutely do believe that it is something that we need to be worried about. And what you mentioned before, when the books get opened up, holy crap, what is going to be found? I don't think it's going to be good news at all.
Thank you so much. Let me take a quick ad break here, guys. MacroEdge.net/ozone, MacroEdge.net/ozone. Support the team. Subscribe to MacroEdge.net. Get that 2-week free trial. See the information we're offering. And I'm going to introduce Six, who is part of our MacroEdge Vision Fund, guys. He's got a question for you. Go ahead, Six.
Not so much a question, but hey, how's it going, guys? Let's talk about some trades. So right now we've got twos that have come down from effective Fed fund. They were in lockstep for a minute. Now they've puked down. I'm at an expo right now. There's some background noise, so sorry about that. But I haven't checked the latest. Now it's under 4. What do you guys think on 2-year yields here?
Willie? Willie, you still there?
Willie, can you hear us?
Yes, I can.
So, yeah.
Oh, there he is.
Yeah, that little red button needs to be clicked. How about that, Zach? Huh? I do foresee 2 years probably going up throughout this year, for the same reasons that we saw the 210 inversion during COVID, and it's going to be driven by uncertainty and terrible financial news. I mean, that's probably only going to get worse as we go on through this first quarter.
Yeah, and I see it going back up too. I think all of it's going to go up. I think right now, what you're seeing in the yields is just confusion, and people are just trying to figure out where things are headed. And as Willie said before about people are moving to the sidelines is very true in all aspects. I mean, I think people are just pulling out just to see where things are really going before they make trades. I know many funds and our peers and even us are doing that.
Yeah, I totally agree. I had a pretty big 2-year position coming off of when Fed funds and twos were flat. I took like half that off today just because it's done so well. But I see it going lower over the next year. I feel like if they continue to move down this path of, at least publicly trying to have some fiscal responsibility here and they might be doing that right as, the economy is already beginning to weaken before they started doing that. And if they do that, I mean, as GDP continues to decelerate, I feel like we could take out the August lows in yields by the end of the year.
That's probably viable. Yeah, I don't entirely disagree.
Yeah. How about equities? I feel like this is more of a sell the rip than a buy the dip kind of regime.
Yeah, I mean, look, when it comes to equities, our investment philosophy has always been, long, short, but very much so long-term value investing. So when it comes to equities, people have to have the mentality of, again, really doing your homework on every company you invest in. We're not one of those types of traders that, that's very active on a daily basis. I mean, we keep an eye on what's going in the markets, but we very much focus on what companies we know that will be there in 5-10 years and will ride through whatever that's happening in the economy over the next couple of years. So So when it comes to trades, from an equity standpoint, if you're going to invest in the equities right now, just be prepared for a volatile next couple of years. If you have the patience to do so, fine. But that's coming from my standpoint. I don't know what your thoughts are, Willie, but I'm not very much of an active trader. I mean, we usually we have a trading team, right? That we just go, hey, we want to buy this. We talk to them maybe probably a couple times a quarter, because we don't, make those little trades all the time.
Yeah, no, you're absolutely right. And like Vince said before, the equity markets are incredibly overvalued. And the thing with patience is not just theoretical. Okay, if you look at the historical, what's called decadal returns of the S&P, when the S&P's P ratio is this high, you're looking at a decade of maybe 2 to 4%. Like if there's a collapse, if there's a severe price correction, it's not something that, well, okay, back up. I can't see the future. If I did, I'd be in Vegas. But statistically speaking, if there's a correction, especially of the magnitude that we and a lot of other people have mentioned, it's not something that's going to be recovered from quickly. On the public equity side, if this thing goes wrong, we could be looking into the mid 2030s at the worst case before things get back to normal.
Yeah.
Do you think that they have the fortitude to not lean on the money printer again before 2030? Though?
Nope.
No, absolutely not. That's the problem.
No, that's we're laughing about it. But if you look at the M2 time trace from the Federal Reserve Fred database, and you see that near vertical spike in 2020 that caused all of this mess that we haven't recovered from. No, that money printer, that has to be one of the most powerful addictions possible if you're at the top levels of government and policy. And if they lean on it, make it go burr, that's only going to make things worse.
It's quite funny. I don't know if you guys have seen all the people on here calling on Twitter, X, whatever, calling for QE is imminent, and as if that's bullish. And it's like, I don't think you understand. Like, you better fucking sell your whole stack if you think we're gonna have QE again.
Well, yeah. I mean, we got Mr. Contradiction driving the Fed, eager for rate cuts. I think QE is going to probably be the last nail in the coffin. And again, we're laughing because it's not funny. It's actually terrifying, and it's very tragic. But what did Vin say previously? What have we posted about previously? What did I say previously? Powell backed us into a corner. We're getting to the point where he's going to have to cut rates just to address the job market, but that's going to be too little too late. And touching rates right now in anything but a sharp upward level is going to make inflation explode. Even if we get our soft landing, which I don't think is physically possible, that soft landing crap only works if you take immediate action, which is the exact opposite of what we've lived through. So, yeah, I don't want to be a doomsayer, but I kind of am. The money printer would be
I'll jump in real quick. The comment was just made by Goolsby. You're not going to believe this.
Okay.
I am partly concerned about slow growth and inflation risks.
No shit.
No, exactly. Thank you. So invest accordingly, gentlemen.
Well, you can be
Yeah,
like.
I mean,
go ahead, man.
No, I'm saying, Anthony, when it comes to equities, we're definitely cautious on equities for sure. In many ways, right? Because if you look at the amount of debt that has been used to buy equities, that's another key thing. Willie mentioned earlier, and I mentioned earlier about the investment when it comes to the shadow banking and these investments that are being made. The market has been inflated by a lot of debt, by a lot of credit, private credit, And then now you're seeing retail investors doing the same. So a lot of the equities market is really, Willie, I think I've said this before, agree with me or not, I would say a big chunk of it is imaginary money in some senses.
It's vapor.
And that's what's right. It's vaporware. So that's why people have to be very careful, because you may see a certain price of certain stocks, but you're kind of going, wait, it doesn't really add up or make sense. And that's where we're at with equities, and that's where we're cautious. So unless you find a business that is going to be a company that actually has true growth potential, that matches with their numbers, then I would go for it. But very, very little amount of companies in the equity side we see in the public market that is valuable. So yeah, I mean, I know it's not the most magic ball answer, but it's just a cautionary answer, put it that way. I know we're not buying much. We're buying more on the private equity side, but in the public markets, it's just, unless it's a company like Rocket Lab or some of these others, I wouldn't touch it.
Well, that brings us to the thing where we're seeing the speculative frenzy, and this is a great question for both you, Vin, and Willie, who are more hardened day to day in the trenches regarding what's happening with the equity markets. We've seen the explosion of zero DTE options. We've seen the explosion of kids, for lack of a better term, under the age of 23 playing in the options market loose and fast, losing their ass or making big fortunes quickly. And now we're seeing speculative ETFs, double and triple leverage ETFs, not just on a small group of stocks, but on individual stocks. None of this has been tested in an actual 5%, 10% down day for the markets. I don't see very good consequences for an actual major corrective action for those instruments, and I don't know that the system can handle it. Your comment, please.
Oh Lord Jesus! Okay, my coffee's hitting. So my coffee is hitting me now. So I'm back. But look, guys, the biggest problem the past decade, right, has not only been cheap money, right? Ever since Bernanke, he fucked a lot of things up for us, and then Powell's indecisions thereafter. But a lot of what we've seen lately, I get the whole decentralization, I guess, of investing and, providing more access to investing for the everyday people. But quite frankly, I'm against that, to be honest. And there's a reason for that, right? Investments require a lot of intelligence and qualifications and certifications for a reason. Right. I mean, Willie and I can't manage a fund, without licenses and without SEC registrations and all those sorts of things. Because look, I'm not saying, Wall Street has been perfect. It hasn't been, but all the fuck ups from them has created more regulation to be able to provide some guardrails. Right. So to allow, for example, Robinhood, right? I mean, Robinhood, I have mixed feelings about, right? I mean, it's okay, it's good to, to provide access to trading that hasn't been before, but it's just, you can't have a market in where such a big chunk is retail, and a big chunk of them do not have the professional, not even training, but the knowledge, the experience, to be able to understand what's actually happening. And I think John, you brought up a good point. That's exactly why we're seeing this right now. Is just, you don't have the system being able to take a step back. The system has not seen this ever before, right? You've always had institutions, you've always had people with actual certifications and experience and training for this. So now when you add a huge chunk of the market that's retail, trading wildly, impatiently, and all the sorts of things, it's unprecedented. I mean, we're going to learn a lot over the next couple of years.
The hard way.
Access, the hard way, and I think this is where government lax of this is a problem with government, right? They either overregulate or they underregulate. There's no, that, and we're going to see that. And on top of that, by the way, to bring that in, you see it in the debt and credit side, right? I mean, these are a lot of these retail investors, the same investors that are using BNPL, buy now, pay later, right? Which is in our opinion, the dumbest thing. If you can't afford $100 item and you have to fucking Affirm or use what was it, Klarna for it, then there's a problem. So that's why we do not like BNPL at all. But it's just we lost our way from a standpoint of respecting the financial system for what it was. And it's like allowing, here's a good analogy, it's like allowing a bunch of, it's like decentralizing medical. Could you imagine allowing a bunch of people that are enthusiasts with the medical field and want to be doctors but haven't gone through the certifications, and they start treating patients? I mean, that's kind of similar.
What's happening.
Yeah, Willie, what are your thoughts on that?
Well, Willie, I'm going to pile some more Red Bull into Vin's system here with a question for you to follow up on that on top of it. Because the best analogy I heard was this is like passing out crack to every prisoner on Rikers Island. So to add on to this problem, we are now issuing ETFs for CLOs, CMBS, and leveraged credit instruments.
Yeah.
This is the proverbial dynamite hitting the pile of dynamite waiting to go off, and all it's going to take is several major bank failures to trigger it. Yep. Your take, sir.
Okay, well, I mean, I got several hot takes, none of which are going to make me very popular, but whatever. I think zero-day options are stupid. I think it's analogous to gambling. If you are doing the research and you're actually saying, okay, well, I'm making a genuine, I'm taking a genuine position with my money, great. But the simple fact is 0 days are a really cheap way for people to try to ape into something, like in the GameStop days of, the heady long before time of 2019 and 2020. Vin is correct. When you have government that's this bad at its job of regulation, and I just want to state, regulation in finance, much like regulation in aerospace, my other field, regs are written in blood. Okay, the regulations exist to protect you from yourself and your own stupidity. Finding that balance is virtually impossible, and the fact that we have so many products, so many new financial products that are coming out that are being pushed as so-called innovative, the CLO instruments, I'm going to be honest, those scare the shit out of me. I wouldn't touch that with somebody else's money. But the fact that you have this glut of just self-serving crap being dumped on the market, I think is a warning sign. If things are going good and the market makes sense and PEs are where they should be and valuations are crazy, there's no appetite for any of that. Okay, it's only when things start to get near the brink that you start seeing people, just get addicted to this stupidity and just start getting desperate. And you want to talk about, levers funds? I know there were, for several years now, there's a couple that were 3x leveraged on oil and gas, not in one particular company, as a sector. What the hell is going on? Why do people think that these are good ideas? As far as Robinhood, I'm kind of with Vin on this one. I have a mixed opinion. I use Robinhood because it's free. I understand that I'm the product because I understand that they're getting kickbacks for payment for order flow, but it doesn't matter to me because of how I invest. Because I don't care if I get a couple cents off of best bidder offer, so Citadel can get because Robinhood can get the kickback from Citadel for order flow. Like, that doesn't matter to me because I am looking at the long term. This is the time where, Buffett would say, when the tide goes out, you see who's been swimming naked. I would double down. This is the time to start investing like you wear crappy brown khakis and a brown plaid jacket as pajamas. Like, this is the time to be super conservative, super 1950s, old balding fat white guy with a pipe, and not do anything stupid. Everything that's being pushed onto retail investors specifically, and the market in general, is going to separate you from your hard-earned money. This ain't the time to be clever.
So basically, you're telling our listeners you're not long MST3L, which is the 3x long MicroStrategy leverage ETP.
It's funny. What was I think it was the guy that started that said posted on X to sell your kidneys to hold Bitcoin.
Yeah, that was that joker. That the wonderful record of Michael Saylor, who said, "Sell a kidney, hold your Bitcoin." This is the most brilliant statement I've seen. And guys, God bless the digital currency movement and all the cryptocurrency people, but the NFTs and the shit coins, for lack of a better word, are no more than an extension to the same thing we're seeing with the triple leveraged funds on individual stocks. This doesn't make sense until you realize it's a final fleecing of retail, who always is the bag holder when there's a crash. And one thing that you've seen, and I'm sure you're seeing it in your institutional flows, and you can verify it too, I'm seeing it, that institutions are raising cash. They're not out aggressively buying this market.
Mm-hmm.
No, that's very much true. And we're doing the same, to be quite frank. I mean, we're raising cash, but we're raising cash in preparation for what's going on. And you're seeing that across the board. And that's what we mentioned earlier. Right now, everyone should be very cautious. If anything, keep your core holdings, right? If there are companies that you have are buying and holding and they're quality companies, you know that they're going to be doing well in 5 to 10 years, then yeah, absolutely keep them. But to go in and buy right now, it's a huge caution. And we're seeing it. Other institutions are seeing, our peers and colleagues are seeing it. So yeah, definitely a lot of cash being raised. There's a lot of cash on the sidelines right now, and yeah, so we're just preparing to buy. If anything, there's more action in certain industries, like for example, in private equity, there's a lot more action going on in the healthcare, life sciences world, biotech, right, and some in the AI world, some of those type of developments. But other than that, you're not really seeing a lot of action, other than the stupid actions you mentioned earlier with these types of ETFs and with these stupid little trades here that they're offering, and we see that as a concern. So not only is crypto a concern, but seeing these products being delivered and seeing government, these regulators being quiet about it is really disheartening to see. It's going to create a bad taste once these implode, and I'm really worried about how it's going to shape the financial markets and the industry thereafter.
Well, let's dig into the big question, because we're heading towards the end of the hour. And guys, you have no idea how much we appreciate you taking the time out from your busy schedule to share with our listeners your opinions. And the big thing I see coming is next Tuesday, we have a non-State of the Union speak from the president, which I fear is going to end up being an inflationary fireworks. So he's going to talk about all these great programs while finger quoting the savings that he's going to try and initiate along the way. In the end, could that be the trigger that finally sets the bond market reversing with higher yields? Because look, I'm apolitical. I hate both parties equally. They both suck. So when you look at what's going on in DC right now, it's one party got lost their spending opportunity. Now we have another party who's going to spend money. I honest to God fear that this guy is going to trigger a fire sale in treasuries, which equities are totally unprepared for.
I fear you may be right. And it's one of those things, like, first of all, I also agree with the apolitical statement. Thank you for saying that. I think if it is an inflationary announcement, and again, I don't know, I'm not the guy speechwriter, all right? If it is something that's inflationary, I think people will rejoice at first until it dawns on them exactly what that means. Yeah, like Vin mentioned, a lot of actions that are potentially inflationary. Tax cuts, probably chief amongst them. And look, I want to pay less taxes, just like I'm sure you do, just like everyone else does. That's great. But unfortunately, if paying less taxes screws me in the long run, well, you know what? I would rather just pay more taxes now. So I don't know what's going to happen. I know from the first term, Trump is nothing if absolutely unpredictable in what he's going to say or what he's going to tweet. I look forward to it. I think it would be a fool's errand to try to have any conjecture. But let's just say I'm not overly optimistic.
Yeah, I'm on the same page with Willie. For many folks listening, I've been, Will and I have worked with the Trump administration and have provided as much feedback as possible. But I think I don't think, I don't think it'll necessarily cause an immediate. There'll be immediate reactions, but I think it's all about if it gets done, right? So what he says, I think, will definitely cause a little stir, but I don't think it's going to be a major sell-off quite yet. What's going to happen is when he actually does implement what he wants to do, is when you'll see the movements take place. Because that's the thing about Trump, right? And this is why you see a lot of money on the sidelines. You see a lot of people, as Willie said earlier, taking a flight to safety. Is because of the volatility and unpredictable nature of President Trump and his administration. Because one day he'll say tariffs, and the next time he backs off, or it's actually going to be a month later. So you just don't know, and all eyes are on the budget bill that's in the House and the Senate, and those talks are getting feisty. Now there's talk about a CR instead of a full solution. So it's just sadly unpredictable. And I think that's why money is still continuing to be a sideline. The monies that are in there is going to be volatile. But I wouldn't do anything. If people would ask, I would say just don't do anything, to be honest. It's going to be hard to really try to figure out what's going to happen until we see actual things take place.
Fantastic. Gentlemen, please promote your fund, promote your writings, promote where they can hear and see more of you, because you guys are always going to be welcome back here every few months. This is the kind of open, frank discussion about markets and the intricacies and inside part of the markets to investing that listeners need to hear, because they hear the bubble visions, the financial media, and think that's the reality. And I am so terrified that there are people who don't pay attention to the reality of what it means to lose a lot of money in a very short period of time.
100%. I'll actually be back on Bloomberg more regularly later this year. So I used to be on Bloomberg TV a lot, and Fox Business and CNBC, but I'm